If you've been following the news lately, there's a lot coming at you right now. Interest rates, inflation, global conflict, and depending on who you're listening to, real estate is either about to crash or it's completely fine. So instead of trying to piece it together from headlines, I want to walk you through what's actually happening here in Calgary, what the data is showing us, and how these bigger economic forces are starting to show up in our local market. And I'll say this up front, we're now in early April, which means we're officially in the spring selling season. The window where buyers are most active runs from now through early July, and getting your home on the market in early July may already be too late. So now is the time to talk. Let's start with the numbers. March was a clear shift. Total sales came in at just over 1,800, down about 12.8% year over year. New listings dropped as well, down roughly 15.2%, but inventory climbed about 4.7% to just under 5,400 units. Months of supply sits at 2.87 months, up 20% from last year. But remember, this is for the entire market as a whole, and just under 3 months is actually not that bad, considering that apartments and townhouses carry a lot of that weight and stay on the market much longer than detached homes and duplexes. So when you strip that away, things actually look a lot different. And the overall benchmark price is $565,600, down 4.2% year over year. So what does that mean? It means we are no longer in the hyper-competitive multiple offer environment we saw a couple years ago. Buyers have more time now, more options, and more negotiating power. But this is absolutely key. Not all property types are behaving the same way. What I just gave you is the overview picture, the citywide average. But when you break it down by property type, you start to see where the real opportunities are and where the real challenges are. For detached homes, benchmark price was around $741,300. Down about 3.3% year over year. Now here's what I'm seeing on the ground. Detached is showing real strength right now. Sales are down only 5% in March compared to last year, which is actually the smallest decline in any property type. And when you look at certain districts, the south and southeast continue to show relative strength, especially for detached homes. The Northwest is also holding up well, particularly in established communities. Detached homes that are priced right and presented well are moving. We're still seeing activity. We're still seeing competing offers in the right neighborhoods. In fact, just last month, I had the opportunity to help a past client sell her home in Mackenzie Lake. We had the first deal fall apart, but we got another offer within 24 hours, and we had a backup offer on top of that. Tons of interest, multiple showings, and this was in the 650,000 range. But here's the thing, there's still a large amount of buyers that are not finding enough of what they're looking for. For example, lake communities are really setting the bar right now, and people are looking in all kinds of budgets. We have a large demand for people wanting to get into a starter home in these communities that provide lake access. They're okay with having to do some renovations or accepting things like poly B plumbing as long as they can buy into the community. Then we have people that are looking to upgrade from these communities or upgrade into these communities. So we have people that are looking in the mid 700s to the 900,000 range. Then we have others that are looking for larger homes, say above 2,300 square feet, and are willing to go up into the 9s. And then we have those people that are maybe coming from a just under $1 million home and looking for that forever piece of property, but not necessarily always in the inner city. Lots of times, the luxury market is mostly found in the inner city and the West District, but there's a large amount of buyers that have built their lives in the deep Southeast or Northwest quadrants that are looking for 3-car garage and a more forever type of home feel. The only problem is, in order for them to go ahead and pull the trigger and list their house, They need to see this inventory come on the market. And we're not really seeing enough of this inventory on the market just yet. And of course, when it does come on the market, it doesn't last. This is a great opportunity for downsizers that are maybe looking to move away from these homes into something smaller. So if you own a well-presented detached home in an established neighborhood, especially in these sought-after lake communities or with those forever home features, you're in a much stronger position than the headlines might suggest. Semi-detached homes or duplexes, down only 0.9% year over year. This segment is quietly one of the most stable property types right now. Not a lot of downward pressure, inventory is relatively balanced, and I even saw this firsthand with my own listing in Airdrie, where tons of duplexes are incorrectly priced and have become stale on the market and are not moving. Whereas we listed knowing the data, going in realistically, and pricing accurately. And we were able to get more than one offer in less than 30 days. So if you're thinking about selling a duplex or you're looking to buy one, this is actually a really solid segment on the market right now, as long as you price it right from day one. For townhouses, those were down about 6.2% year over year. This is where things start to soften a little bit more. Buyers have more options. They're taking their time. They're negotiating. Inventory in the townhouse market is up 27% year over year. So there's more supply out there, and that's putting some downward pressure on prices. So if you're selling a townhouse, you need to be realistic about pricing, and you need to make sure your property stands out. Same with apartments. This is one where we need to be really honest. Apartments are down 9.3% year over year with a benchmark price of $300,300. And here's the bigger story. Condo supply in Calgary is sitting just below levels we saw during the 2008 financial crisis. Inventory is up 7% year over year. Months of supply is sitting at 4.77 months. That's almost 5 months, which is the highest of any property type. And the city center has more condo inventory than anywhere else, with over 738 units available in the apartment sector alone. So if you're looking downtown, you have a lot of options right now. The Northeast is also seeing slower absorption, especially in the apartment and townhouse sector. Listings in the apartment sector in the Northeast continue to be slow and move slow to even get showings. So if you're selling an apartment right now, you are competing. You need to be sharp on pricing, you need staging, you need to stand out, and you need to be patient. The patience part is tricky because sometimes you may be doing all the right things and still not getting enough showings to get sold quickly. Having different exit strategies is important. And here's something I just saw. A stat came out yesterday that 73% of agents did not do a single deal in March 2026 in the Calgary market. And this is where it's super important to not just go with a relative or a friend, but to really understand that this market requires expertise, especially if you're selling. Listings at any price point require a higher level of experience. I'm so glad that this last luxury listing that I sold created over 250,000 engagements online, which is equivalent to 1 in 7 Calgarians seeing the video. And that's 2.2 times the size of Red Deer in engagement. And eventually we were able to attract the buyer through LinkedIn. But if you're buying a condo right now, this is one of the best buyer environments we've seen in years. You can take your time, be selective, and in many cases, negotiate pretty aggressively. So the big takeaway here is the Calgary market is not one market right now. It's several markets, and they're all behaving so differently. 2 of my favorite quotes are, "Fortune favors the bold." So even though it may seem like this market update has favorable news for some, less favorable news for others, that's just the way these markets go. And sometimes where there can be loss, there can be treasure for somebody else. You just have to be bold and be in a good enough situation, hopefully, to take advantage of it. Another quote I love is by Warren Buffett or Charlie Munger: "Be greedy when others are fearful, and fearful when others are greedy." This is a market where for the right person, it may be a total win. and for others, it may not. Now, what about investors? Here's where things get a bit more specific because we have thousands of purpose-built rental units coming to the market over the next year or so. And what that means is more rental supply, which is going to put downward pressure on rents. So if you're investing right now, your strategy has to be tighter than it was a couple years ago. Cash flow is going to be more important than appreciation assumptions. And what I mean by that is this. A few years ago, investors could buy a property, maybe break even on cash flow, or even run slightly negative and bank on the property appreciating in value over time to make that investment worthwhile. But in a market where rents are softening and prices are under pressure, you can't rely on that necessarily anymore. You need to make sure the property actually cash flows, meaning the rent you collect covers your mortgage, property taxes, condo fees, and maintenance, and still leaves you with something at the end of the month. Is that a lot to ask? Yes, absolutely. The majority of the numbers for a long time haven't always been cash flow positive, especially if you don't have a significant down payment, and oftentimes 20% is not enough. And if you've already purchased and are not in this situation where you are cash flowing, it may be time to revisit whether or not you want to keep this investment or let it go, or prepare to hold it long term and assume the positive and or negative risk that can come with that. So if you're banking on strong rent growth to justify your investment, you might want to revisit those numbers, and being conservative is key right now. If this is the type of content you've been looking for, please show your support and don't forget to like, share, and subscribe. Now let's zoom out a bit and talk about what is driving all of this. In March, the Bank of Canada held its policy rate at 2.25%. This wasn't a surprise. We've been on hold for a few meetings now, and the reason is pretty straightforward. On one side, the economy has shown softness. On the other side, inflation risks are rising again, and that's largely because of what's happening with oil prices and the ongoing war in the Middle East. So the bank is in a bit of a tough spot right now. They're not ready to cut rates. They're also not in a position to raise rates aggressively. They're waiting, watching inflation, watching the economy, and they're not in any rush. Now, from a mortgage perspective, here's what you need to know. Variable rate holders, your rate didn't change with this announcement, but fixed rates, that's a different story. Fixed rates don't move directly with the Bank of Canada rate. They follow bond yields, and bond yields have been moving up recently, which means fixed rates have been climbing as well. So if you're shopping for a mortgage right now, fixed rates are more expensive than they were even a few months ago. And here's why that's important for you. Fixed rates directly affect your buying power and your monthly payments. When rates go up, the amount you qualify for goes down because lenders base your approval on your ability to handle payments at the contract rate plus a stress buffer rate. Right now, fixed rates are sitting around 4.5 to 5% depending on your lender and down payment. Just a few months ago, they were closer to 3.9 to 4.3%. And here's what that means in real terms. For every 0.25% increase in your mortgage rate, your buying power can drop by roughly $10,000 to $15,000 depending on your income. So if you already have a fixed rate held from, say, a month or two back that may be expiring, you're still thinking about buying, it's time to stop thinking and take advantage of this better rate that you have, especially if fixed is the way that you personally want to go. Because if you lock in a 5-year fixed, you're committed to that payment for 5 years, regardless of what happens to rates during that time, unless, of course, you were to break the mortgage, which comes with a big penalty. And that penalty may offset any savings if rates were to go down. Now, for some buyers, this is making variable rates look more attractive again. Because if you believe rates are going to come down later this year because inflation cools or the economy in Canada continues to soften, then locking into a variable rate gives you flexibility to benefit from those cuts when they happen. And you can always lock in a fixed rate later if you feel more comfortable. But here's the thing, that's a bet. And it's one you have to be comfortable with because just as there's downward pressure, there's also upward pressure. And this year, they seem to be happening more and more close together. So rates could also stay where they are or even go higher if inflation surprises to the upside, or if the war and oil situation lasts longer than expected. And that's the risk you're taking with a variable rate right now. It's important to think about your own risk tolerance, as that answer may be different from person to person depending on what season of life you're in. If you're looking for a mortgage broker, I'm happy to recommend one. So what about inflation? Inflation came in around 1.8% in February, which is actually below the Bank of Canada's 2% target. That's good news, right? Well, yes and no, because oil prices have increased significantly since then due to the conflict in the Middle East, and energy costs flow into everything: transportation, food, construction. And here's the part we're all feeling. We have some of the highest food inflation we've seen in years. In fact, Canada's food inflation has been running significantly higher than other G7 countries. While many G7 countries have seen food inflation drop to around 2 to 3%, Canada's food inflation has been hovering closer to 7% over the past year. And for a lot of families, that's really draining household budgets quicker than we'd all like. So when we talk about inflation risks rising again because of higher oil prices, it's not just an abstract concept. It's something people are feeling every single day at the grocery store, at the gas pump, and in their monthly bills. And that's the part why some buyers are being more cautious right now. At the same time, we're seeing very confident buyers in the market that just know what they want and aren't seeing enough of it. So I would say for the younger, more first-time buyers, yes, this is a real concern. But for buyers that are already well into their years of raising families and have been through ups and downs in inflation, they're better equipped or have already adjusted to handle this. However, everyone's definitely feeling it. This is where Alberta really stands out. Canada overall lost 84,000 jobs in February, and unemployment rose to 6.7%. In Alberta, employment held steady. Unemployment sits around 6.3%, and Alberta is leading the country in job growth at about 3.3% year over year. So while the national headlines feel weak, Alberta is actually holding up better. However, I am concerned about the lack or the slow rate of employment growth in youth populations and in boomer populations that are not yet ready to retire, because those are the groups that are most vulnerable in a softening job market, and they're struggling to find or keep work. That puts pressure on household formation and housing demand over time, let alone affecting people's own well-being and sense of meaning. Construction has slowed from last year's peak, but we're still expecting around 45,000 housing starts in Alberta this year compared to 55,000 in 2025. So builders are still active. They're just not building at the same pace as last year, and here's what I'm seeing. I don't necessarily know if ramping up more supply is the right move as a builder right now. I, for myself, who flip properties, have definitely slowed down on flipping. Not because I don't want to continue, of course I do, but it seems risky for me to speculate in the market right now. Or the property types that are worth flipping in are at higher prices to get into. But builders are definitely trying to move existing inventory by offering upgrades, closing cost credits, covering legal fees, or other incentives to attract buyers, such as contributing to condo fees for a period of time. Builders oftentimes seem inflexible to move on price, but this is why having a realtor represent you on the buy is extremely important to make sure that you are getting a fair and reflective negotiation of what builders are seeing, not just what's in their best interest. I know this news has been getting old and you've been hearing it for quite some time now, but here's the thing. People are still moving to Alberta, and the reason continues to be affordability. But we're all feeling the increased cost of living. Yes, we've been feeling it for quite some time now, but just as we're feeling it, people in already more expensive areas, places like Toronto and Vancouver, are feeling it that much more. And those people are continuing to look for more affordable options like us. Even though, yes, our prices have gone up, we're still significantly more affordable than most major markets in Ontario and BC. That gap has narrowed a bit, but it hasn't disappeared, and that's continuing to support demand in Calgary. Now, this is something newer in the market, and it's worth talking about because it could be a real opportunity for first-time buyers. There's now a GST rebate program for first-time buyers purchasing new homes, up to $1 million full GST rebate, $1 million to $1.5 million purchase price, partial rebate, and up to $50,000 in savings depending on the price you're buying into. So if you're a first-time buyer looking at a new build in, say, the $600,000 to $800,000 range, you could save anywhere from $30,000 to $40,000 on the GST alone. That's significant. That could be the difference between affording a down payment or not. Now, here's where I want to add some context. A lot of first-time buyers are looking in communities at the extreme ends of the city, places like Seton, Hotchkiss, Pine Creek, and some in the Northwest, because there's a lot of new builds over there, and that's where the GST rebate applies. But there is some risk involved in buying in the extreme ends of the city. These communities tend to have more volatile prices. They're less established, there's fewer schools, fewer amenities, and longer commutes into the core. And if the market softens, these areas can be hit harder than established inner city neighborhoods. So if you're buying in one of those communities, I would think of it as a place you plan to live in for at least 10 to 12 years, not 5 or 7. And because that's hard to guarantee, especially for young couples and first-time buyers, it's tough to say whether this is the right property type or not. So it's important to have multiple exit strategies. That said, the GST rebate is a real benefit, and for first-time buyers who are looking at new construction, it's absolutely worth taking advantage of. Now, I want to share a bit about what I actually saw in the market in March, because it's not all doom and gloom. March was a hot little month for listings for me personally. I had the opportunity to sell a $4.2 million listing in the luxury market, and the buyer actually found me directly through LinkedIn, which was pretty cool. The buyer has now purchased that property and has continued to list his home with me as well. A $4 million home in Altadore that is just stunning and an absolute delight to be in. I got the chance to bring my family into the listing video and really showcase the feel and love of the home. And I'd say it's been one of my favorite listings I've had as of yet. I also got the chance to help that past client I mentioned earlier sell her home in Mackenzie Lake. That deal, we had the first deal fall apart. We got another offer within 24 hours and even had a backup offer on top of that. Tons of interest, multiple showings. People are still out there looking. And what I'm seeing is that there's lots of interest in certain communities right now, both in the $650 price range, as well as people who have been living in their homes for a while, maybe in just under the $1 million range, and they want to upgrade into something with a 3-car garage, a bigger lot, maybe a walkout basement, and a one-of-a-kind feel in the southeast quadrant of the city. So if you have anything like this coming up, please let me know. And if you're thinking about selling a property like this, please know that there's limited inventory and there are buyers specifically looking at that type of home, especially between 1.2 to 1.6 million. The challenge is that there's not enough inventory for that buyer. So if you're in that position, if you own a well-maintained detached home in an established neighborhood with those features, you're in a really strong position right now. Meanwhile, listings in the apartment sector in the Northeast continue to be slow, while a duplex in Airdrie can move relatively quickly if priced right. And properties at the extreme ends of the city can still move slow depending on pricing and presentation. And the ultra luxury market above $4 million in Calgary is getting a lot of attention, which makes sense due to the time of the year and being the hottest time for people looking with families, with homes selling in multiple offers and very short timelines. So depending on what you're selling, you may be able to buy and sell with the buy coming first, Not something that I would typically recommend, as of course there's risk, but depending on the property type and the community that you're trying to sell in, it may be possible. Definitely not with apartments or townhouses, but if you're selling in a well-presented, detached home in a strong neighborhood, it's worth having that conversation. Real estate is definitely more challenging these days, but presentation and right pricing can make or break a deal. And if it's not done right, it can actually cost the seller tens of thousands of dollars. When inventory is higher and buyers have options, your home needs to stand out. It needs to show well in photos. It needs to feel move-in ready when buyers walk through the door. This is why having a stager work with me is one of the best investments that I make in any listing that I take. In certain homes, a staging consult is provided prior to listing. If the home is pretty much ready to go, then my stager will come in on the day of. All the staging items that we bring stay during the time that we're listed up to 1 month and can be renewed thereafter as necessary. And any staging that is done is meant to enhance the way that your property will show on the market and cater to the lens of the camera and what an ideal buyer would be looking for. I do have a preparing your home to list checklist that I share with all my sellers. And if you're thinking about selling, please reach out and I'd be happy to share it with you. On a related note, we have a downsizing webinar happening this Sunday at 10 a.m. If you're thinking about downsizing, maybe you're an empty nester, maybe you're looking at simplifying, maybe you're just overwhelmed by the size of your current home, this webinar is for you. Comment downsizing below to join us. And I'm also super excited about the book club momentum that we've been having in our leadership and personal development mastermind. We started off with a big leap, moved on to essentialism, and last month we read Buy Back Your Time. And this month, we're doing 10 times is easier than 2 times by Dan Sullivan. And I'm very grateful for the opportunities and the people I've gotten to meet. So if you'd like to join our fully complimentary virtual book club, it happens on the last Wednesday of the month. You don't have to have read the book, just be interested in the conversation. And it's absolutely free. Comment book club below and I'll get you the email. I also got to be on a video for the Calgary Real Estate Board recently as I'm the chair of the Governance Standing Committee. It's more industry related, so I won't dive into details, but it's part of the work I do to stay connected with governance in the industry that makes my world go around and feeds my family. It's part of how I give back to my own community. This is not a crash and it's not a runway market either. It's a transition. What we're seeing right now is more balanced condition, more negotiating room, more selectivity from buyers, and more pressure in certain segments, especially condos. If you're selling, you need to be sharp on pricing. Buyers have options now, and overpricing shows up quickly. The days of just testing the market and hoping for multiple offers, those days are fading. Pricing, staging, and positioning are going to be the difference between sitting on the market for 60 days versus selling in the first 2 weeks. Right now, there's only 2 pricing strategies that are working. Please reach out to find out which ones those are. And here's the timing piece. We're in early April right now, which means we're officially in the spring selling season. Historically, the window where buyers are most active runs from now through early July. So if you've been thinking about selling, this is the time to act or at least start the conversation, not in August when the market starts to slow down again. If you're buying, you have more leverage than you've had in a while, especially depending on the property type. In condos, you can take your time, be picky, and negotiate. In detached homes, there's still competition in certain neighborhoods, but it's not the frenzy we saw a couple years ago. And people are being more mindful of their commute, their community amenities, and their long-term plans. So if you've been waiting for a better buying environment, this is probably it. Calgary is not moving in isolation. There are a lot of external factors influencing what's happening here. Interest rates, oil prices, inflation, migration patterns, cost of living. But at the same time, our market is behaving differently than many others across Canada. And that's where understanding the details really starts to be important. If you're trying to figure out this market and how it applies in your specific situation, whether that's buying, selling, or investing, reach out anytime. I'm always happy to walk you through it. And as always, if you like this video and found it helpful, please don't forget to like, share, and subscribe.